Part two is application. How do we apply this? So anything that you're doing now in token space, look at three things. What is an asset? Which token are you dealing with? What gives it value? What is an asset? And you have to understand that question really well. What is a token? What does an asset represent? So whether you're looking at USDC, USDT, and maybe US rupee is far away, I think. Oh, sorry, the tokenized rupee is far away at the moment. But let's say there's tokenized rupee in future. You need to find out as to what is the asset, what is giving it value, which is what is it representing? Is it representing a symbolism, or is it representing like a Dogecoin, some of the other elements? And there are ways to look at this stuff. One is somebody will claim an asset as this. You will go to the GitHub. You should look at, I look at that. I look at how many code commits you have. So for the longest time, Doge, which was on the, have you heard of the Doge story, all of you? Dogecoin? It was a crazy, Elon Musk tweets would just push it up. And many of us like, there's no development happening on that. There's nothing happening on it. You know, it's like a junk bond. You're hoping that it goes up, and it's like just gambling. So you need to look into, I look at a few things, which I'll discuss either today or tomorrow. There are 8, 9 factors I look at. I look at the maturity of a protocol. I look at the market cap. So any market cap is more than 400 million. I put that in for CAs and in people who want to do investing here. Look at, you have to be in, like you have many new projects, a lot of promise. But there's a lot of work and sweat and blood goes into making this promise a reality. So I look for maturity. I look for at least 2 or 3 years in existence of the founders who understand this stuff, right? And so if I am a financial guy, I'm trying to build something for healthcare industry, well, that's a red flag. Like, what do you know about healthcare industry? So there's still some of the element of founders, people who have the idea, look for 400, my current threshold is 400 million and above, which means your token value should be, market cap should be more than 400 million above, to even consider that in your portfolio. I look at GitHub. How many commits? How many are the developers? So you have some projects who has amazing name, beautiful marketing, but like 2 guys behind the scenes writing code. But if you're dealing with digital marketplaces, programmability in every step of the way, you need to have an army of good people. So either you have good developers, or you have good architects who are leveraging something like Gitcoin, or the developing ecosystem community to write code. And if there's no activity happening in the project, that to me is a red flag, regardless of what the market cap is. So you can have a very high market valuation of a token, but if you don't have the fundamentals in place, that's a red flag. And so I look for that level of detail in every token that I evaluate, or I try to put in my portfolio. So there's another question. We all know what this is, right? So you have stocks, bonds, equities. Banks have a system. They have a risk model. They will lend you money. They will take your collateral and everything else. What happens to, Rashi, is your question, is your identity, your healthcare record, your ability to be able to say that you're an educated person, you're getting in this journey, your earning potential is much higher than a mid-age career guy who's maxed out his pay stub, for example. Banks don't have any way to calculate that. So that is, for many of your potential opportunity in this case, the global valuation of all the assets in the world, so every home, every car, and every gold piece that you have in your house, is today estimated about $471 trillion globally. So that's how much asset is valued, that's how much money is in the system that we play with. And that's a lot of money. But if you were to include some of the elements of non-tangibles that banks have no way to evaluate, right, that you're willing to pay for. So for example, I know for a fact that if there's a family heirloom and you decide to collateralize it, chances are you'll come back for it, right? Chances are you'll come back and release your lien on your healthcare record because that's valuable to you. So that is called what we call non-bankable asset, and that is, so 471 trillion. We expect that to be $2.8 quadrillion. The question is, how much is a quadrillion? Anybody? Give it a guess.
1,000 trillion.
Yeah, but I think it's 1,000 trillion. So imagine the numbers that from 471 trillion to 2.4, 2.8 quadrillion dollars, that is unrealized value that banking doesn't get. Something to keep in mind, and that's the opportunity landscape you have. So if you do look at pre-internet and post-internet, it was, I think, about initial days 10x, 100x. Eventually, I think you begin to see Baidu, Amazon, Alibaba, Paytm, so the world truly taking advantage of internet. So when you buy stuff from Amazon, they are amalgamating payment systems. They're tracking and tracing, supply chain. There are at least thousands of systems behind the scenes that you don't understand or care because you want your almonds the next day, for example. So that is the true value of layer 4, which I'll explain in a few minutes. The question that you should be asking yourself is, what is that project, what is that entity that is not only aiming to go for 2.4 quadrillion dollars, but which is the next generation of the Googles and Amazons of the world that will be there? And that's the landscape. And right now, you're very nascent. You're in the early stages of that journey. You had a question, Rashi?
Not a question really, but I think I couldn't get this part right, where the unrealized value of assets.
That's good. So for example, we talked about this clinical trials. So what is the value of a healthcare record? So why will I, so let's say I'm a GlaxoSmithKline, for example. Well, I need a lot of data. And I need to do studies. And data is expensive. And I had to pay participants to come in once a week or twice a week. And it's a clumsy process. But what if I can get access to targeted audience of, let's say, they ask for a male between 30 and 45 who has these conditions. If I can simply provide fractional ownership of the healthcare record, which is an NFT, to GlaxoSmithKline, they bypass the entire process of all these things, and they pay you in return. So you can monetize your healthcare record. So when you go to a bank, and you want to say that I want to borrow money against your healthcare record, because now your healthcare record is monetizable, which today it's not. Or you can look into saying that you want to get money on your own credibility, on your own reconnaissance, in terms of the fact that you are upwardly professional, you are educated, you have a good job, which is what credit score is all about today. So suddenly now you can borrow money against your own credibility, and you will maintain that because that credibility matters to you going forward. You see what I'm saying? So that's what I'm saying, that is unrealized potential of the banking system today from tokenization perspective. And what Tokenize does is allows them to hold. Right now, all credit agencies provide, this is the Web 2.0 versus Web 3.0 transition, they only give you a score, some subjective algorithm that decides who you are, which means you just graduated. Who just graduated here? Somebody just finished school. Firoza, you did? So your score is like very minimal at the moment because you're still exploring the job market and all these other areas. But Firoza has potential. You do. In terms as a student, is up and coming, who's educating herself. So can she then say, look, I really want to do this. Can I borrow money against my own credibility? And they should be able to invest in it, which is what all the examples of all the NBA, so this digital marketing people, the NBA players who are collateralizing their own tokens say, hey, you can put money in this DAO, and I'm going to give you 15% of my future potential, future earnings of basketball players who can be anywhere between $80 to $300 million. So if you invest in these basketball players and they do really well, then you get a massive payout. So can Firoza do that? Can Firoza build an NFT? I'm sorry, I'm picking on you. I don't mean to. But let's say you have Firoza NFT, and it's all gung-ho, like it's super bright. She has like amazing scores, got into all these Ivy Leagues, IIT, IM, and all these things. And yeah, let's invest in her. And we'll then have access to X%, or this DAO will have access to 15% of her income for the next 15 years. That is what I mean by that. Does that make sense?
Also, are there more point that like use cases of replacing data with NFT?
Yes. So you are. At the end of the day, NFTs then become data. In fact, all of blockchain is data. It's in a tokenized form. So if you look at a transaction in Ethereum, it has certain characteristics. It has nonce. It has the token address. It has the DAO address if you are the smart contract. It has the address of the from and to for processing transactions. But it also have other data. You can have your comments, and you can have the processing, how many nodes processed, at what time this was processed, and everything else. All that is data. The reason why it's tokenized and it makes it valuable, because it's immutable. You cannot change it. And because you cannot change the data, and this is again for people who are new here, Blockchain 101, it's a chain of blocks. And the data, every time a block is processed, a transaction is committed. So you cannot change any of this data, and that's what makes it valuable. So you cannot go back and redo the history. You have to create another transaction to undo the previous one. Does that make sense? So this is where things become interesting. So if there's anything you should take away from this day and a half that we have left, is this slide, because to me, I always go back to it. Every time I see a token, I'm like, where do you fall? Where do you sit here? Because you have all these, and by the way, every story, every white paper, every PowerPoint looks fantastic. It's like, man, this has a lot of potential. And so you have to ask yourself two questions. Where do you sit? And this is mine. I wrote a paper of this, but there are many such frameworks out there. You have 5 layers, which, by the way, there's a layer 0 here, which is Web 3.0. So blockchain is a Web 3.0 technology. And after this session, we'll jump right into Web 3.0 for many of the open questions that we have there. But you have one below this, and some people have one layer above that. But nonetheless, it's a framework. So you pick your poison and go with it. But the whole thing is you have layer 1. Bitcoin, Ethereum, Solana, Cardano, example of layer 1. Hyperledger Fabric, example of layer 1 protocol. They provide you with a basic structure for transaction processing. They give you data, they give you blockchain, they give you all the elements that you need to process a transaction. And the discerning element between public and private, so you should know the difference between public and private. Public blockchains are truly global blockchain networks. Ethereum, Cardano, Bitcoin, these are globally available. Anybody from anywhere in the world can open a wallet, open a node, and start working on it, as long as they have the right computer, right wallet, right common sense to protect the keys and everything else. And then you have permission network, which is Coda, Hyperledger Fabric, which is sort of meant for a consortium. And we'll spend, end of today, I'll give you an example of trade finance network. Because not every bank, every company can jump into Ethereum and start mining. You do need advantages of the same things that we've been talking about all morning to apply to an enterprise, apply to supply chain, apply to financial services. And they cannot jump into this because it's less understood. It's got more risks. It's the early days of internet, right? Where so I think that's where things are. So that's protocol layer 1, foundation. And one thing that it does, it gives you a settlement protocol, settlement instrument. So Bitcoin, you can settle with Bitcoin. All the things that we talk about from a fungible token perspective, the characteristic of a currency, you can take Bitcoin and you can settle with it. Layer 2. How many of you can give me an example of layer 2? All the blockchain guys in the room.
Polygon.
Great, Polygon. Why is it layer 2?
Because it's using Ethereum. It's a fork of Ethereum to actually process the transaction faster.
It's not a fork, but you're right. It's a layer on top. So anybody else? And I will pick on, what's your name again? Bhavya. Why do you know layer 2 from a, you have Matic on your system? Yeah. So remember this. These are global protocols, right? So when you swipe your card or you do real-time transactions today, it happens right away. Because these are decentralized protocol, there's no governance, or we use the word governance there too. No one tells you what machine to have. So it takes 14 minutes, 7 minutes, which is not acceptable to many of us from the way we have been used to transactions. So layer 2, and there's no privacy, which means that in the financial world, there's something called BSA, which the entire world, there are agencies like FATF. So if you're interested in compliance, there's a whole ocean of challenges that blockchain brings to the compliant world, which is the financial services world. 1 minute, I'll just finish this piece and then we'll go over there. So the question layer 2 is, it solves what layer 2 doesn't solve. So for layer 1 to be effective, it needs to give you a basic decentralized infrastructure or centralized infrastructure in case of permission networks. Transaction processing, sending anything of value from point A to point B, I need to process transactions. I need to have a ledger. I need to have a smart contract. I need to have programming models. These are all fundamental capabilities of layer 1. But layer 1 does not solve all the problems in the world. Then you need layer 2. So Polygon, for example, and Matic is the ass in Polygon. They sit on top to provide things like scale, speed, efficiency, and security. To say you can't move fast enough. So what Polygon does, sits on top. Say it's Ethereum. It sits on top of this and say, I'll process this faster for you. So I'm taking a subset of transactions. It's called a side chain or layer 2, and I'm going to process this here. And eventually the single source of truth, which is the strength of blockchain, I'll commit that to the underlying Ethereum network. So the terms, for example, what you see with Lightning networks. Have you heard of Lightning networks? Bitcoin? So what Lightning networks does is Bitcoin is even slower because it's truly decentralized. And if there's something you should write down for technical people, look into trilemma. Is blockchain trilemma, and I'll discuss this a bit more today if the interest persists. It's a technical element that you cannot achieve speed and true decentralization around the world because there's element of physics, there's light. I mean, we are limited by the speed of light in terms of how fast we can process transactions. And the question then becomes that, so Lightning Network basically does the same thing. It creates channel between two parties, and so if me and Muskan is transacting, thank you for putting the name tag, it makes it easier, I had to find the names there. If we are transacting on a blockchain network, then we open a channel and we constantly transact and no one knows what's happening between us. But once we are done with our transaction systems, we close that channel and we commit that state to the underlying blockchain state. So that's how that's why it's called layer 2. If this is layer 1, layer 2 protocols sit on top. They either provide scale, which is giving you 1 million transactions per second capabilities for bringing the enterprise-esque or the real-world transaction processing system on top, or allowing you to be able to do things like privacy. So if I can introduce privacy in this world, or in this case, like Polygon actually acquired 3 companies. So I sit on calls with Sandeep and some of these guys quite a bit in terms of, and they have done an amazing job. To me, it's an iconic Indian company now, which raised $500 million a few weeks back. Amazing vision in terms of applying. So they acquired a few companies in terms of privacy, in terms of zero knowledge proofs and everything else, to say that if banking industry wants privacy, we can still do all the things we do from blockchain perspective and apply it here. So when you commit a transaction, no one really knows. I mean, you're still committing a transaction for the sake of providing a record, for ensuring you have the single source of truth, but I'm still able to obfuscate the real name of people and so on and so forth. So I built a system on Stellar for payments, and I did exactly that. I had a layer 2 solution that we basically said we're going to obfuscate all the names and everything else, and all we're going to commit is from and to. That's it. So you have a wallet address and you have an asset and you simply move that asset. That's what layer 2 does. I'll pause here. You had a question? Shreya?
I have a question. I just want to understand the Polygon situation. But from my understanding, is the fact that since Ethereum's network is slow, Polygon takes up a bunch of transactions, runs it on its chain, and then just transfers the output to Ethereum.
Yeah, so sidechain concept essentially. So basically, most layer 2 do that. So layer 2 cannot exist. Remember, these are layers. You can't have layer 4 on its own. So layer 2 cannot sit on its own. It has to have some layer 1. So Lightning Network does the state channel transformation for Bitcoin. Polygon, like networks, and you have Arboretum and other networks who do the same thing. And you have now, which is a debatable topic in terms of Cosmos and Polkadot, who are calling themselves Protocol Zero, but they are providing interoperability, but they cannot exist on their own, because the only thing that can exist on its own is layer 1. But it has to be usable. So just having a great tech, it has to be usable. So what Polygon does is exactly that. They're applying all this technology, whether it's rollups or whether it's allowing you to.
I was just about to ask that. I've been hearing this terminology called ZK rollups.
Yeah.
Are they the same thing?
Yeah, same thing. So Polygon applies something called ZK rollups. So basically, rollup is Ethereum sort of ecosystem, and I think to me all this is a risk, because Ethereum itself is, the layer 1 is going through a massive shift. So what happens to all this tech that you have built in the last 10 years, which is reliant upon all these other constructs that layer 1 provides? So from that perspective, I think that rollups, all the rollup does is it rolls up. So me and you transacting, we roll up all the transaction and put the delta into the blockchain network. And there where you're not processing every single transaction, you're simply doing a delta of the transaction. And ZK is adding a layer of privacy on top. Yes. No. This is good. It's. Pardon?
Who's validating these?
The Polygon. So you remember this, right? Good question. I'll explain it. I'll explain as many times as it takes, right? Fundamental thing that blockchain provides. So remember, even this has their own tokens. So Matic is the token that Polygon uses. And you need token to process the transaction there. So they process transactions. So think of a blockchain on top of blockchain. So they do verification validation, and you have to pay in their currency, the native currency of that asset. And then they commit that to this network, and they pay currency for gas on your behalf to Ethereum.
They aggregate the entire.
That's right. So instead of you processing one transaction and paying, let's say, a gas fee of, $400, they take 1 million transactions and pay a gas fee of 4. So that means that 4 million transactions would have to have some profit margin to make up for the one gas fee that you're paying lower level. So to your question, rollups, right? Essentially the same thing. Like if me and you transact, and let's say we're on layer 1 protocol. Well, because of the congestion, remember it's a global network, it's slow, and you only have so many validators on the network, they will charge you a fee. So me and you can choose to transact $10, but it won't be commercially viable because I have to pay $300 to process $10. Doesn't make sense. So what ends up happening is you go to a layer 2 solution, you transact $10 there, right? And what they do is they aggregate like 1 million transactions, make them into one transaction, and pay. That's what rollup is. You roll it up like a batch process at a very basic level. There are a lot more down to the detail, how that happens and how do you verify it's your wallet. It means you have to have a wallet on Ethereum wallet, and that ties into the EVM compatible and goes into a bit of technical sort of element of how do you discern between, how do you make sure the transaction actually got processed as a wallet holder because you're transacting on the network. But rest assured, let's say that's happened, but all Rollup does for you is allows you to batch them all up, and you sort of pay a combined community fee than paying a single fee that we do. And in Lightning Network, we do the same thing. Lightning Network is one-to-one. So it's like me and you having a private blockchain. But we can never have a private blockchain because we need a global state to verify who me and you are, right? Otherwise, we might as well just deal with cash if you simply transfer to people. Because at some point, you take this asset to transfer other people in the network. Does that make sense?
Yes.
And we can dive deeper into it too if you want to go.
Can you discuss on the data structures, how the blockchain operates, and what is gas fees exactly? Why is it required?
Yeah, so let me finish this piece. I'll go back to layer 1, only because there's a thematic element of us going with the high level and diving deeper into especially Web 3.0 piece. Because I think I actually want to finish 3 and 4, because that will digress into technical level detail of how that will happen, right? So that's layer 2. Okay, so for layer 2,
Yeah.
questions?
So one thing, this Lightning network, which is basically a state channel,
Yeah,
it is basically a payment gateway.
it is a payment channel,
Payment channel.
not a
right?
gateway. There's a difference. And the gateway basically, it's a gateway, right? So when you process your card, that
Payment
goes
channel.
through a gateway that sends it to Visa, MasterCard, depending on what you're...
Right. Right. Payment channel. Whereas for what about side chains?
So Polygon is a sidechain. So it's a network on its own right. And Polygon can have multiple networks. They can have multiple sidechain. The sidechain can basically gives you the same blockchain level access to provide a, it still does state machine management, but you're able to process transactions in the whole network per se. But whereas Lightning is always between peer-to-peer.
Okay.
So in a Bitcoin network, if you're on a Lightning node, right? So you have a Bitcoin wallet. Let me actually explain this here. Just
So basically, small intermediaries.
correct. But you also need a state management at a. So in this case, in sidechain concept, so everything is a state, right? Blockchain. And this should actually get into your question too, right? At some point. So this is chain. You cannot append this, and every time you process it, it keeps processing, and this is sort of layer 1 protocol, and they basically commit. Every single transaction is batched into 10, depending on the block size. You batch those things. Now comes the sidechain. So here I may have wallets. You have a bunch of participants who have wallets, and you have, let's say, Polygon. You have sidechains. So you have a network level state management here, as opposed to peer-to-peer. Now in this case, let's say this is BTC, I can do a state management here, within peer-to-peer. Or I can do a state management between 5 parties. So me and 4 of us can be on the same network. And at that point, if any of the participants want to leave, they can close their state channel and commit that data to blockchain. So which means you're still tied to the source of truth.
Okay.
That is on the layer 1 network. So state channel management for peer-to-peer on layer 1, as opposed to state channel management for a network on. So which means you will have a single source of truth, which means when Polygon commits its transaction to this network, it's giving you it has a hash, just summary of the transaction, which means if you have to go to the breadcrumb analysis, you take that and you basically query this network to say, give me more details on the channel, because this state doesn't have any information about what rollups were doing, what happening here. So that's a part of the transaction. So this is network level state management, and this is peer-to-peer or group level state or state channel management. Does that make sense? It's a slight distinction, and most layer 2 can be a bit confused because they all sound alike. But there's subtle differences between the use cases that govern. So Twitter and El Salvador are relying upon state channel management because they're all Bitcoin. So again, this industry is very polarized, where you have Bitcoin maximalists who are saying Lightning Network is the best. So it's more of an ideological difference, but technically they're essentially doing the same thing with a little slight differentiation between taking the entire state versus taking the peer-to-peer or a group state and committing that to the blockchain network. And to answer your question, the data structure on the contrary element, it's a structured data. So the debate we keep having in this industry is, it is structured. Everything in the blockchain world is structured. You have, in a typical transaction, you have the nonce, you have the timestamp, you have the from, to, the asset classes as a foundational element of the data. Unless you go those with like 6 or 7 different areas. Then you have ERC, which I don't want to go into right now, which basically takes that data and gives you programmability of how to deal with the data from the Ethereum sort of request for comment, or ERC, which is a standard that's emerging. But the gas fee is calculated based on network demand. It's a little bit more involved conversation, depending on how many validators, what the fee structure, and in future Bitcoin will also have the same model after all the Bitcoins are mined. So I'll table that for now. It's a little deeper. That's how is gas fee calculated, because it's a difficulty level. There are a number of validators, there's gas fee structures, and now you have the EIP 1442, I think, which allows you to dictate as to how much you want to pay. So if you're not paying a lot of money, nobody will pick up your transactions, and you have to wait for a week. But if you pay a lot of money, it'll be picked up right away. So you're giving a choice framework for people who are creating blocks, grouping blocks, to take your transactions and do the verification validation and put them into a block to be processed. That's a very good fee structure that goes with it.
So essentially then layer 2 is basically moving away from decentralization.
Yes, that's a great point. So while layer 1 is decentralized, fully decentralized, most layer 2 becomes quasi-decentralized. Yeah. Because if you think about Polygon, or even Lightning Network, you can have a node in that core too. So you can have an Ethereum network or a Bitcoin node, and you can have a Polygon node, and you can also run a Lightning Network node, because everybody is getting paid. So running a Lightning node, you get a piece of the commission too. Because you're paying a Lightning fee network in Bitcoin, and they amalgamate those fees together to process one transaction, or when they commit. So you have to create Lightning Network servers to be able to create the peer-to-peer channel we're doing, and you have to pay a fee. When you close that state channel, the Lightning Network gets paid before you commit the transaction to the blockchain network.
So basically we're trading off transparency for speed.
There are trade-offs, and this is why Trilemma, how many of you have Trilemma? Man, go for it.
So it's a common thing that no cryptocurrency, no blockchain can have speed, scalability, and decentralization together.
Yeah, that's fine. So for just I'm going to high level. We can dive deeper later. There used to be something called a CAP here, very old in distributed computing. It's called consistency, availability, and partition awareness. So consistency. So when you update your data, so when you bank with, who you bank with?
SBI.
SBI. Me too. It's an interesting experience, but let's say so we bank with SBI. So sometimes things go bad. You go to a different server because one server is down. So, but when you do a transaction, that transaction is committed to a database. But for high availability, they have to maintain copies of the database multiple places. So consistency means that if the database fails and you log in again and you're diverted to a different database, next thing you say, hey, I still have the same amount of money even though I spent a lakh, for example. So that's consistency. And it's a bad thing, and it's a good thing in financial world. It's a bad thing not to have consistency. So the system that you design has to have a trade-off to say, if you make an update to a database, I have to make update to all the database who I have a backing, but that involves laws of physics, that involves other methods. So that's what we call consistency. Availability is the same thing. I have 2 or 3 or 6 of everything, which is what happens in the front end. So all the mobile, all the applications, they look the same. They take your own login. but your data is your transaction information. And one way to address the scalability is partitioning, which is what blockchain does a lot of. You partition the data, all the layer 2 is partitioning, keeping what you need in all the different corners. The system says you can only process, any system in the world can only have these two. You cannot have a system which is the holy grail of having all three, because you're limited by speed of light. Right, because that's the communication network. Transforming blockchain takes us a whole new level. As Shreya was saying, decentralization implies I have more and more servers all around the world, which means I have to deal more with the latency issue of the respective communication networks, the network communications, and the fiber optics versus copper versus all the other things, the physical layer that happens. I deal with what's the next one? Shreya? Scale. So because you are dealing with this massive sprawl of system, it's hard to achieve scalability, because remember, the reason why layer 2 exists, because layer 1, as global and as decentralized they get, it becomes hard for them to process transactions at a level. And the last one, Shreya, is security. And security is not your, let me turn on TLS and HTTPS and now we have secure. Security is basically security of the transaction where, let's say, when the network gets compromised or you have some element of attack on the transaction, the system is able to correct itself. So the whole general idea is that the more decentralized the system is, the more fault tolerant it is to other attacks to the system. But then you lose out on scalability. But if the system is not scalable, you truly cannot create a global system which has the needs of our application at the moment. So there's always a trade-off, there's a knob. So layer 1 has always focused, at least in the permissionless world, is focused on, because the industry has said that decentralization is what you need for a global system to go with, and decentralization automatically, which is why we've seen issue with Solana going down and some of the other elements going down, right? And the system who are focused on security, Solana, for example, have not been decentralized, and you've seen the outages and the challenges they've had recently from us. So there's a trade-off. And so layer 2 exists to address that trade-off. But enough of the lower level tech. Where things super get interesting is layer 3 and layer 4. And my focus now as an investor, as a fund manager, and as a technologist, I'm looking at layer 4, which is the next Google and next Amazon, next Baidu's of the world, of the Web 3.0 world. But layer 3 is oblivious of this lower 2 levels. So you'll find many projects, and this is where I will explain in DeFi next slide, as to how do you value token, and where does token get its value. But layer 3 basically looks at services. These are applications. So in a transaction, you need a fungible currency, right? We talked about that. You need something that's fungible. You need something to exchange it with. You need an exchange. So you need all these different services. And that's layer 3 protocol. They begin to start giving you blockchain services. Your walleting structure is a layer 3 protocol. Your ability to have a stable coin, which is taking a currency or taking a fiat into converting into a stable coin, is a service. Well, stablecoin by itself doesn't do anything, but you need it to exchange it for other asset classes, right? And then you have the token issuance, the verification validation services, the people who are running the Lightning Network nodes are all layer 3 because they're providing a value-add services on top of these layers, which means layer 3 cannot exist on its own. So you need to have some layer 2. So when you evaluate the tokens of this layer, know two things. How are you handling this? How is the network handling this stuff? What is the valuation of underlying tokens? And what's layer 1 protocol? Which means today, my biggest concern, which I haven't really, and Ethereum community is fantastic about that, is what happens when Ethereum moves to 2.0. And we'll not go into details in this session, but that's a big concern. So that's layer 3. This is where things get super interesting, is layer 4. So again, I'm dating myself. I was there when I was in college when internet was going on, and we were trying to explain as to what happens when you do speed of information transfer, like file transfers. And people ask, okay, that's great. You're doing FTP, you're doing all these things. How is it going to affect my business? Well, what happened in the internet era? All the information brokers were gone. So how many of you actually go to travel agent now? How many of you go to travel agent? No, but you go to travel agent? You do? Can you please leave? I'm just joking.
Because corporate rights are not there in.
You don't use Amex or any of the portals to go and. I'm asking you to, when I say travel agent, there's some guy sitting behind a green screen talking to a Sabre or one of those. So you go to Amex, or you go to some guy, some website, right? But you're not going to a guy who's sitting and giving you all the ticket options.
My parents do.
Yeah, that's right. So there are still some people who exist in that era, but most of us don't, and that.
Those agents still get you cheaper tickets than.
Yeah, because
Just to compare prices.
Yeah.
They do.
Yes,
So the question is, why aren't you all using them? Convenience, right? I mean, I think that, at least the context that I have from a US perspective, we don't have any of those guys left anymore. We have a corporate travel agents, and you'll have one very few of those guys, but by far, the airlines themselves, and I know this because I've worked with American Delta and all those guys, they offer the cheapest on their website. So I look at Expedia first, then look at the website and see which one is cheaper and go down that right. But my point, without getting into the nitty-gritty of who uses this, is that those information brokers are largely gone. And we still have Expedia and Trivago who are targeting your experiences around it. So the question that becomes is, who are these entities in layer 4 who will be the removing agents of the value brokers? The people who are involved, the brokers, and the LIC guy who's selling you some financial instrument, coming to your house and doing those things, and who are those value brokers, and what can we do in this space? And when I discuss a DeFi stack, we'll talk about the whole element of why this is an important part, and the valuation in most cases. So the reason about travel agent entities is, back in the day, the companies who were doing compression was highly valuable. This is compression at the lowest level, which is data transfer level compression. Companies like Linux who are coming up with Linux operating systems for enterprise were very, very valuable. But we don't pay for them anymore. I mean, I don't remember paying for a company that provides an amazing level of compression because we take that for granted because the industry has matured to that point. So the question is that now, after almost 30 years of evolution from internet, we see Amazon's becoming the next sort of the beacon because they are truly taking advantage of aggregating all the workflows. So after internet, we had Web 1, Web 2, which is the next discussion we have, and we had BPM. How many of you worked in business process management? Boy, I'm really old here. So business process management was one area where we took e-commerce and we began to provide business workflows. Every company had a business workflow. Even your company today has a business workflow. They're using SAP, using Oracle, using one of those systems which lets you design a workflow to say, if you apply for an approval, it has to go to these 3 layers, which is a frustrating part. When you apply for an expense, people have to go and approve those things. That's BPM in general. And internet has flattened that structure. So if you go to Amazon, I've never called Amazon customer service, because their customer service is also flattened. Has anybody called Amazon customer service here?
Yeah.
You have. Yeah, so I've never called, in almost 2 decades, never called Amazon customer service because all that is done via chats and channels and yeah, because they have amalgamated and flattened that structure to the whole thing. My question to all of us is, as this industry evolves, who are these emerging players? So if you heard of Yearn Finance, have you heard of Yearn Finance? Anybody? Yearn is one of those projects, 1inch. They're providing a massive aggregation to say, where can I optimize your investment? So if you have an Ether, give it to me, and I'll find the best place for it. You give me this, model that stuff around it. And we in the VC community are also looking at creating a layer 4 protocol for having a VC DAO, which removes a lot of intermediaries and a lot of sort of hurdles that you have from an investment perspective. So keep that in mind that for people who want to, who's someone who actually, I have dollar sign, such it. That's where you make money. Layer 2, layer 1, eventually become TCP/IP protocols and they'll eventually normalize. But this is still very hard because you need to build a foundational structure. For the next, I would say, 5 to 10 years, they will still be dominant. But I'm looking at layer 4 now, which has an exponential growth pattern because they will grow with this. It cannot flourish on its own until they fix these problems at this layer. 2 more slides, and we'll take a short break. We go back to Web 3.0 type elements. So I put this together as DeFi stack based on, so this is a generic layered protocols for blockchain in general. So not all blockchain companies do everything. So just because somebody is slapping in the blockchain label in front of their names doesn't mean they're blockchain companies. You have to figure out as to where do they sit. And that'll help you put things in perspective as a first step, whether you're a CA or whether you're a smart contract developer. Because when you're developing a smart contract, if you're doing it here or even here, your perspective is different, right? And so as a technologist and as an investment class, try to put that in perspective, which I think makes a lot of sense. And in this case, the settlement layer, digital asset layer, DeFi application, and niche sophisticated services. So this is layer 4, which is the 1inch and yuan protocols. But settlement layer, because you're processing transactions, whether you're going through a layer 2 protocol, Lightning Network, or layer 1 protocol, at the end of the day, when you settle in any of these, Solana, Cardano, or Algorand, or BTC Bitcoin, or Bitcoin, Ethereum, how are you settling it? How are you paying for it? It's not in rupees. Any question? How do you pay for this? When you settle a transaction, which is a gas fee, commonly known as gas fee, how do you pay for it? In the network currency.
Yeah.
So in Bitcoin, you pay in Bitcoin. In Ethereum, you pay it in Ethereum. So that becomes a settlement instrument. That's why it's important that if anybody who's in a truly global decentralized layer 1 network, and you have Bitcoin and you have Ether, they become a universal asset class, which is the belief system, the currency of sort, which has these 3 characteristics that we discussed. So that's a settlement instrument, and that's important. Because if the network is not popular, not scalable, doesn't have the right audience, is not truly global, then you'll not see the ecosystem develop on this. And I give layer 1 as a nation state, that as the layer 1s grow, they're attracting capital, they're attracting best talent. And that's why Ethereum has the biggest community. Solana is trying to replicate that, have biggest community around it. Bitcoin has biggest community, because they actually are truly a digital global nation state status in general. Right, and so I did a podcast on this topic, listen to it. I spend every week in what I learn and what we share in the investment community. But this becomes a layer 1 protocol. At this point in time, US dollar or fiat currency, or euro or rupees, is not in the stack. And the reason for that is because it has no place for it. The only reason why you need to have on-ramp off-ramp from a bank, this is a really important part, is because not all of us can be miners, not all of us can be stakers, and not all of us have the know-how. So the easiest thing for us to do is buy it. Buy a token, which gives us the right to participate in that ecosystem. And that's all we all are doing. We all are spending our cash to buy this token and say, now that I have a token, what else can I do with it? Can I participate in a stable coin and get better returns than what banks give me? Can I take this and participate in liquidity pools? Can I go and put an Ether into Aave, and there are protocols now which basically say you can borrow money and leave your asset there, and over time, the asset will pay itself off and you can get the asset back. A new financial instruments are all together, and then you have these sophisticated services like fund management and lead management and so on and so forth. I have a question for you all, because I've had a monologue for now. How do you value assets in this structure? So if I have a token from this wall, like urine, for example. Urine is very expensive. How do you value it? Knowing all that we know about layers and layer 2 and how does token dependency happen, and yes?
Fundamentally, the amount of layer 1 resources that are utilized by the subsequent layers.
Okay, that's a good one. So what you're saying is the valuation of layer 1 contributes to the whole thing. So the more demand layer 1 comes, layer 1 goes in value. Ergo, proportionally that goes. Brilliant. That's one data point. Anybody else?
So basically the cash flows that you get on the gas fees that the community gets over the years through when the layers are being built or and the transactions happen on layer 1.
That's great. So one was L1 cost. Second was the transaction fee yield, if I can use that word, right? In terms of how many people are involved in it, and what's the fee structure for all the services they provide? Because none of it is free, right? There's no free lunch in this world. There's no free lunch anywhere. Even the free, I just learned this yesterday. You get a free alcohol bottle apparently in Delhi. Someone's paying for it. Is that true? Is that true? That's all we need, more alcohol in the system. But the point is that even that's not free. Someone's paying for it. Right? Somebody's paying for it, whether it's taxpayers, etc. So there's a system in the, so you're right, you have the transaction fee yield where somebody's making for that fund, they're providing all the services. Anybody else? That's it? Only 2 ideas? Shreya.
Like more, like the amount of money locked in or like the liquidity that they
Total value locked? Expand on that a little bit. Because all I'm doing is taking an asset, collateralizing it. How does that add to the valuation of any token in the system? Because remember this, there are multiple tokens at play. One token is that you own from any of these. So each of these layers have their own tokens. So you need that token to get and play in the system. Whether you buy it or you exchange with the layer 1 protocol, which is truly fungible, or you simply exchange one asset for another asset, and now you have the token so you can participate in that ecosystem. So total value locked. If I were to take Ether and lock it into a DeFi application, how does that add to the valuation of the token of any DAO or any application in the space?
So for the DeFi application specifically, I just feel that for example, like pancake swap or Uniswap or any of those, like the more amount of like liquidity I'm providing for other coins, the more number of like I'm raising the more yields and more returns you're able to get from the same as well.
So Shreya mentioned a few things which we should discuss. What? Shreya's. Okay, sorry, Shreya's. My apologies. So Shreya's mentioned you have market makers, and market makers' job is to provide liquidity to the system. All they figure out where's the demand, where's supply, what is the price point that we can do in this space. Traditional to any traditional financial markets, and they provide liquidity to the system. So total value locked in many cases is over collateralized today. And that's why the risk, we have debated the risk in financial industry or in DeFi is a lot less than the risk in the traditional finance, because most traditional finance is under collateralized. So you're buying a house, but you're borrowing more and you have inability to pay for a house. All that is not factored in. They look at the price of the house. So in case of housing bust in any country, suddenly the home value goes down. So overvalued home prices actually have an adverse effect on the economic system of any country. What we do end up doing in this case is most TVLs have a trigger mechanism which basically has a built-in to say you have to put in, if you want 1 Ether worth of dollars, you're putting 1.5 Ether over collateralized asset. So in case Ether goes down, there'll be a liquidation event and we will liquidate the assets, and that way you are having stopgap measures against these things. So if you look at the previous slide, this is how the protocol guys make money. One is token-based models. Every protocol has a token, which gets a bit confusing because suddenly now you will have a Ether token and you will have a stablecoin token, and then you'll have a token for Aave, and you'll have a token for EEL. And you have all these tokens in your wallet, and you're wondering, what do I do with this? I'm hoping there's enough clarity in this room, but that can be a bit confusing for the common man. Like, you have all this token, what do I do with it? And what does each token represent? So the question for us is, what is the monetization angle? And when you build a portfolio, your risk and your diversification should come from some framework like this. But the question is, how do protocols make money? And essentially, it's basically you're making money as layer 1 protocol as gas fees is one way for the network to make money and incentivize the infrastructure. Token as a medium of exchange. All the layer 1 protocols, just like US dollar, is a step-through currency, and that's how they do their spreads. Commercialization of protocol, which is what Hyperledger Fabric and Corda have done, is taken the technology, and which is what Aave is doing now. As you know, Aave has gone into Arc, which is taking the Aave protocol. They have solved this problem globally for some of the other elements. Like, can we take this to the traditional finance institutional investors? So that's, again, to me, Aave is in layer 3, Aave is in layer 4. Suddenly, Aave has gone down to layer 1 for the institutional finance. Now, remember this, that once you go from permission to permissionless, it becomes a little bit challenging because the economic systems change. Permissionless is consortium-based, permission is global type elements that go with it. And last thing is the power of network. Many projects on the network are super cheap today because they want to, just like Google, Facebook's, they want to have enough critical mass before they begin to monetize their space. So especially NFT projects, many of the NFT projects are relying upon the power of network to say, if I have enough people believing in music or pictures or photographs or whatever, let me build enough critical mass, and then I can embark on that journey. And that's essentially some of the models that we go with. Any questions so far?
Basically, to summarize, how the valuation will be basis the liquidity and the volatility of the asset, the transaction, number of transactions.
So hold that question for a minute, because there are multiple levels of valuation. You can go with technical analysis, like fundamental analysis, which goes into total value locked, overall market cap, trading volumes, the OHLCV, which is the open, high, low, close, type volumes. But we, in the crypto space, at least me, I have 8 factors that I look into. And I want to discuss that tomorrow, because we're going into all crypto tomorrow. In terms of, so I look into code, I look into momentum, I look into trend analysis, I look into the founders, for example, EOS. I don't know if you heard of, have you heard of EOS, guys? So EOS came out like $4 billion. They're defunct at the moment. And community has decided to just not fund so the founders are now extracting money from that whole ecosystem, and community decided, we're going to give them money around it. So to me, that's a valuation criteria to say, hey, what have you done since inception, like 4 years, 5 years? What have you done with the money that you raised, and how many developers do you have on the system? That's another criteria which is completely ignored by the financial community. And what is the code contribution? Because most of these layer 1 projects are meant to be open projects. So how many developers are you attracting? Which for Ethereum, Rohan wants to be a smart contract developer, and first thing he said was Ethereum. So have we gotten that level of community, that innovation, which is why I call layer 1 as a nation state status, because like every country is trying to attract the best, the brightest, the capital. Layer 1 with their programming models and the tooling is trying to attract the best and the brightest people in the world to come up with the algorithmic elements of how do you manage this without the intermediaries. So that's the criteria I use, because if we do what we did, we'll always get what we got. So if we apply the existing financial, which is the biggest challenge with many of the market traders who come, as you may have seen, they're applying the same thing, what they know for commodities and equities and driving the market. Many of them don't even understand. Like if you talk to many of the actuarists in the space, they don't know what the project's all about, but they can read charts. They can read the candlesticks and they can apply Monte Carlo analysis and all these things. They can say with certain certainty, but that will change, because the intention of what we are building as a community is a little bit different from existing financial product. So whether it's a temporary blip where market is going exactly what the actuarist and the analysts are thinking about, will eventually change, because the thesis, the underlying business is different. It's not the traditional finance that we know. Anyway, digital asset payments, I'll skip this piece a little bit because we had done this, and it'll answer some of your questions in terms of real-time AI. There's a lot of scenarios that I use when I work with our financial industry, including the Ministry of Finance here. This is the thing. You just cannot have a token that has so much value. I look into market infrastructure, which is the number of people we described who exchange assets. I look into Reg and Comp, which we'll not discuss today, digital asset custody. Remember this, right? How many are familiar with custody? How many of you are familiar with existing custody? What is it? Exchanges don't do it. It's part of market structure, but they go to a custody bank. So remember, the market is created for counterparties so that not one party can manipulate the market or manipulate the system. So they have a custodian, and custodian keeps the asset. And if you want to do any exchanges, you have to go to custodian to, basically custodians take it from here and put it here, and they say we're keeping it safe. But in digital asset, custody is different, because asset, you have the claim to the asset, but asset always sits in the chain. That's a fundamental difference, that no one's keeping it safe for you. It's not like, just like gold or whatever you have, your bank papers, your house papers, they are not keeping it safe for you. Asset always, tokenized assets always live on the chain. All you have is a claim of an asset in form of a private key or wallet. So that fundamentally changes the entire structure of the market, which relies upon trust that you have to keep on all these counterparties to keep things safe for you, right? So some of these areas, and this all happened in the last 2 years. When Bitcoin, I remember for 2014, we had explicit instructions from our leadership to say, don't use the word Bitcoin when we talk to financial service industry, is a bad word. And now all banks want to do is talk about Bitcoin and Ether. So this is a transformation, and these are all big names that happened in the last 2 years. It's actually, it should be 2021, including the regulators. And almost $40 billion has been gone into from a banking industry in simply understanding the space. So many of you who are mechanical, electrical engineers and CAs, you have a new avenue to look into this and say, where do you fit in this entire ecosystem? You pick a bullet and stick to it, and I think you'll have a pretty decent ride for the next 4 to 5 years as this industry emerges.